Hello, hello, everyone. Welcome back to another episode of The Week in Charts. I'm Charlie Bilello, and with me today, special guest once again, Jamie Battmer. Welcome back to The Week in Charts.
Charlie, thank you very much for having me back. Appreciate it.
Great to have you as always. And really, nothing's happened between now and the last time you were on the show in March. Nothing big in the markets, no bear market to speak of or tariff craziness. Just a boring period of time in the markets.
Markets are kind of where they are. Assume nothing happened. Wait, a ton happened, but hey, it's great. Lessons, good reminders of what to do, what not to do, and so some great stuff to talk about since I was here last. Thanks for having me back.
Absolutely. And if you're watching this on YouTube, take a quick moment, hit that subscribe button, leave a comment, like the video. I read all the comments and try to respond as many as possible. Today, Jamie, we got a lot on the docket. Goodbye, AAA, the debt downgrade. One big, ugly deficit, and you probably know what I'm talking about there, but we'll dig into that. A bond market revolt, some interesting action in Treasury yields this week. The world strikes back. International outperformance, huge so far this year. I want to get your take on that. Housing market supply continues to creep up, and prices are actually now starting to go down just a little bit, but something to take note of, I think. And we'll end with something positive, as we always do, which I'm calling the long piece. Okay, Jamie, let's dig right into it. Goodbye, AAA, the last of the three major credit agencies here, downgrading the U.S. government debt from AAA to AA. This was a long time coming, in my view. Why did they wait so long? But Moody's finally joined Fitch and S&P Global in downgrading the debt and citing, no big surprise, that we're going to have big fiscal deficits. We have growing interest costs, and it seems like every administration, whether Republican or Democrat, they've failed to take any action on this. What's your take? We're going to discuss all of the debt and the deficit and that stuff, but what's your take on these rating agencies? Is this meaningful at all? I know there was a big reaction back in 2011. In 2023, Fitch didn't get that same response. This week, not a big response, I would say, so far in terms of the markets. Do you think this is meaningful in terms of this downgrade, or investors can safely ignore what the rating agencies are saying?
Well, the deficit spending currently and what's projected moving forward, warrants concern. We've talked about that a lot, and we'll dig into that later. But what's history tell you to do, right? Would it have made sense in 2011 to respond emotionally and say, run out of equities, run into cash, run into bonds? No, that would have been the exact wrong decision at the exact wrong time, because it would have been emotional, right? Fear driven, just as bad as greed driven. So take it what happened in 2011, right? Sticking with what's right for you, regardless of what downgrades are occurring, upgrades are occurring. Didn't another element actually upgrade to stable at the same time? And so there's all this movement, but use history as your guide, and keeping calm after 2011 was the right strategy. Keeping calm now is probably the right strategy as well.
Yeah, I'd say regardless of what happens in the short term, because back in 2011, of course, I think that was in May of 2011 when the downgrade came, and there was a 20% bear market that year. This year, we already had the 20% bear market, and we've clawed out of most of it already. So anything can happen in the short run. We're not saying for sure that the market won't react negatively to this or something else. Of course, that's possible. But really, the question is, does any of this change from an equity market standpoint? Does this change the ability of companies in the U.S. to grow their earnings? And I don't think, as it stands right now, anyone's questioning it. So while the U.S. government, Jamie, is very much behaving irresponsibly and running these massive deficits, U.S. corporations are very much not. If you look at their profit margins in the first quarter, growing once again. So big delineation here between the way the government operates and the way corporate America operates.
Yeah, it's really interesting. Actually, you mentioned corporations, but households as well have really been like balancing their books, like putting themselves in better debt ratios, kind of at the expense of the government. So government's taken off what corporations and households have maintained, actually gotten in better, their better financial house in order over that time period. And yeah, you mentioned, a couple times before these 20% downturns. I think didn't 2011 and just now, like theoretically, it went down 1.20%. It didn't actually close down 20% in either of those periods. So it's like you're right there. And but the point is there was a snapback, just like a snapback right now, and take advantage of it. Don't flee it in fear.
Yeah, we didn't hit the 20% on a closing basis in many of these bear markets. I always include intraday because it's close enough. 19, is clo to me close enough to 20. What 20 is that magic number? And intraday, if you don't include intraday, 1998 wasn't a bear market.
Yeah.
2011, 2018, all of these, and this year so far, all of these would have fallen short, but close enough for government work, as they say. And this is the big problem here, as we'll talk about in this next section, the interest on the debt. So the debt reaches a level where you're paying so much in interest that it starts crowding out other areas theoretically in terms of the budget. And it just becomes a spiral because you have this increasing debt, you have interest rates going up. And so the cost of that debt becomes harder and harder to service. And just last year, what we saw was the amount we're spending on interest on the debt is now higher than what we spend on defense in the US, which is kind of remarkable. 1.11 trillion, and the expectation is this is likely to continue to go up. Why is that, Jamie? Because we have one big, ugly deficit,
Hmm.
very different than the way they're phrasing this bill. They're calling it one big, beautiful bill. I had to check that a few times to see if that's the actual name. It seems to be the actual name of the bill. I guess you could call it whatever you want. But in terms of the bill here, the Congress very narrowly passed this bill, 215 votes to 214, with one lawmaker. I don't know who that voting present. I don't know. How do you get away with voting present on that type of bill?
The ultimate political move, right? I'm here, but I'm not
Yeah.
doing anything.
I mean, come on, take a side. You either like it or you don't. Just to say you were there. I mean, it's almost better not to me not to vote at all. Just like don't show up.
I'm sure they've got great free food there. So that president vote, he was still able to get something
Good
for
point.
themselves. So
Good point. Okay, so there's a lot in this bill, Jamie, and so it's not just extending the tax cuts that from 2017 that were expiring, which I think most people were in favor of, in terms of just keeping that going and not having a big change in terms of the tax structure. In addition to that, in addition to extending those, what they did was do a whole new host of tax credits, deductions, different things. I'm just going to run through some of them here. I want to get your opinion on them. They increased the standard deduction, increased the child tax credit. The big one that was a promise during the campaign, no tax on tips, up to 25,000 a year, overtime pay up to 20% of your regular wages. In terms of seniors, they were talking about no tax on Social Security. They couldn't obviously, I think, push that through, but they got a 4,000 bonus standard deduction for people ages 65 and older. So kind of removing some of the taxes from Social Security, and increased SALT deduction. This was a big one, especially in my state here of New York, where we have super high taxes, state taxes, property taxes. Well, in the last bill, they limited the cap on that to 10,000. A lot of people went crazy over that, and to get the Congress people from New York to vote on this bill, they had to entice them by increasing this up to 40,000. And lastly here, lower corporate tax rate from 21% to 15% for the portion of your business that's domestic production. So a number of these things were floated, over the past few months, but I think very few people assumed that all of this would be included in terms of the bill. What's your take overall? Anything here in particular stand out as egregious? We shouldn't be doing this. Obviously, there's some people that will benefit from this, some people that won't. What's your overall take on the major tax provisions in the bill?
Well, the key is, nothing signed into law yet, right? And so we're not going to spend too much time kind of having our dedicated subject matter experts in tax analyze this until we know what it is. And, that's really
Yeah.
when we jump into action, right? When tax code actually changes, not when it might change or when regulations change, right? When they changed the rules for private equity to be able to own NFL sports franchises last winter, right? That's when we started to say, okay, could this potentially make sense or not? When regs change, when tax code changes. Issue here is, there's winners and losers. Like you said, there's pork involved, right? To get those people over the end, that states, the larger salt deduction. I'm not here to opine on that. They clearly didn't solve for any of the real issues facing us, right? That's a concern. There's pros and cons, winners, losers on each side of that. But it's interesting, both sides of the political aisle, like the additional standard deduction for taxpayers 65 and older, right? Again, if we're really going to attack some of these things, the huge amounts in, entitlement spending, Medicare, Social Security, both sides, because 65 and older crowd, they vote at a disproportionately high percentage. Both sides are never willing to kind of face up to the elephant in the room and make some tough decisions where we can really tackle the stuff that we can control. A lot of the Doge stuff is stuff, it was stuff around the edges, right?
Yeah.
Even if they did execute. So that's a concern. Tax on tips, it's you're really playing winners and losers there. Political move. I know some of my first minimum wage jobs, I wasn't getting tipped on anything, and so that's a shame. I know you and Peter have opined on that again. The lower corporate tax rates, again, usually, like the idea is when that's lower, hopefully it incubates, more commitment to redeploy capital effectively. The domestic production, again, what's that mean? As if I was running a global company, okay, is that still a benefit versus the lower cost of capital overseas, right? So there's a lot of variabilities in here.
Yeah.
Overall, winners, losers. It's not dogma yet, so we're not ready to jump in. But clearly, they're not tackling the real issues of reining in the spending.
Yeah, so the big question coming into it, Jamie, and I think we now kind of have our answer. As you said, this is not a done deal by any means. It's going to be now sent to the Senate. The Senate obviously can reject it, make changes, send it back to the House. So this can go on and on. They're hoping that at some point in July they'll have a final bill for the president to sign, but definitely no guarantees. What they what the pushback was initially was that this is going to increase the deficit. So what they were saying a few months ago is, oh, if we cut taxes on things, we're going to find spending to cut to go along with it. And when it comes down to it, that's very hard to do, as we talked about a few
Yeah.
months ago, because everybody is has to answer to their constituents, and no one wants to have their pet project or be cut right at the end of the day. So, yes, did some things get cut in this bill? Yes, but overall, spending did not go down; it still went up. So now you have this combination of you're lowering taxes and you're increasing spending overall. So what is that going to do to the deficit? It's going to drive it up. And just my point on some of this stuff, like the larger standard deduction to me, if you want to cut taxes, fine. That's the best, probably the best way to do it. Just do it for everybody universally through that. The tips and overtime, now you're picking people in certain
Yeah.
professions that receive that. Not really good policy from a fairness standpoint. The SALT cap, personally, even though I would benefit from that increase, I don't agree with it because it's subsidizing states with high taxes. The rest of the taxpayers have to subsidize that by giving them a deduction. I don't think logically it makes sense to get a federal tax
Well,
deduction for state income tax that you pay.
you're welcome from Missouri, Charlie.
Yes. But this is showing you, Jamie, essentially, how do you get this big, quote, beautiful bill passed? Well, a lot of ugly things have to happen and a lot of deal making has to occur, and you have to get people from different states that have different priorities to come together. And when it comes together, it's this big, huge bill that most people probably don't even take the time to read, unfortunately. But breaking it down, what is the big impact overall? The impact is likely to be an increase in the deficit. Now, there's different projections. There's no way to calculate this exactly, but it seems every projection from anyone, if you look at the CBO or the Committee for a Responsible Federal Budget or the Tax Foundation, they're all projecting this is going to increase the deficit. You have estimates of about 3 trillion over the next 10 years, and that would be 300 billion per year an increase. But a lot of this tax cuts that were in the bill are front loaded, Jamie. They're set to maybe expire in a few years if they're not extended. So that means we're going to have bigger deficits in the early years. And you and I looked at this chart a few months ago. 2 trillion was the deficit coming into the year. We're still at around 2 trillion today. And we said if you had to guess, it would be higher or lower a year from now. And I definitely said lower. It seems like we're headed in the lower direction. And now it seems like I'm going to probably be wrong about this. I don't remember what you said, but it's really unfortunate that we're not at a moment yet where people view this to be any sort of crisis where they have to worry about the deficit.
I mean, that's why guessing is a fool's errand, right? And what the future holds, because you never know what's around the corner. Future forever remains unwritten. It just shows that again, we're really since the global financial crisis of '08, that this has kind of been the standard prescribed medicine to put the fire out. And like oftentimes, sometimes the cure can become worse than the illness itself. And yeah, markets are dealing with it. The economy is rolling on, but it's almost like the concern is it's almost like a heart attack, right? It's not an issue until it's the only issue you have to deal with, and that's what we're dealing with. The one thing though is yes, this is I am really not wanting to burden my kids and my kids with us not getting our checkbook in order. But this isn't a uniquely American phenomena. That's the key to this. It's just our numbers. We're such a large part of the overall global economy that just
Yeah.
our numbers are huge. Like this is a playbook that the vast majority, and sometimes vastly more than us, has been exercised across the globe. The fact that we're the global alpha economy gives us more leeway to get away with it. But again, sometimes the headlines are misleading because our numbers are so gigantic where, Botswana might be, juicing it relatively speaking more, but the absolute dollar is dramatically lower. So it's
Yeah.
unfortunate. We're not solving for it, but it's not a uniquely American phenomenon.
No question. Yeah. And yeah, the numbers are huge because we're the biggest economy. But if you convert it to percentages, that's where it becomes troubling because we're really in unprecedented territory in an economic expansion, running deficits of around 7% of GDP. And the expectation is that's going to continue if this bill passes for a few years. And all of that, Jamie, is assuming the economy stays strong, right? And we have the revenue coming in to support that level of deficit. Of course, if there's a downturn in the economy, this number goes down. We currently have around 5 trillion in tax revenue coming in, 7 trillion in spending. That's how you get to that deficit. But it seems very likely this top line number is going to go up over the next few years. And this bottom number, we don't know. Like the tax revenue, obviously, there's a lot of tax cuts in there. If there's economic growth, like that will still go up, but probably go up less than it would have if not for these tax cuts. And what that means, Jamie, is the national debt is almost guaranteed to rise. And this is why I always laugh when we talk about a debt ceiling. You can't have a ceiling in the debt. So we've been stuck, if anyone's been paying attention, we've been stuck at 36.2 trillion in national debt because it hit the ceiling early this year. So you say, well, how is the government running a deficit if we hit the ceiling? Well, they take from the general account, which had close to $1 trillion in it, and we're just drawing that down every month. But we're getting closer to a point where they're going to need to raise the ceiling. And within this bill, lo and behold, they're asking for a $4 trillion increase. So Polymarket, one of the betting markets, has a bet out there. Will the national debt surpass 38 trillion this year? And 80% probability as of now that it will. So it seems very likely, Jamie, once that ceiling is raised, that we're going to just explode higher in terms of the debt.
Yeah, if someone is going to make an investment decision based on, a emotional reaction to us about to, you know, not raise the debt ceiling, not do that, you're just not following the trend line over and over again. Rinse, repeat, it's political standoff. No one wants to give in till last minute because they seem like cowards to their side. And so a lot of smoke and mirrors, and then all sides end up capitulating and, continue to feed the Leviathan.
Yeah, but I think the big lesson is like once again, do not listen to don't take politicians at their word. So all of the talk about cutting the deficit, we're going to cut it in half, or we're going to have a balanced budget. I was very skeptical of that. I was hopeful maybe they would reduce it a little bit, but definitely this notion of a balanced budget, there's no chance of that happening, right? There's just simply where there's no appetite. So getting back to it has to be a heart attack. It does seem to have to be a crisis, Jamie, in order to get people to be really serious about trying to reduce the deficit and put us on a better path. And speaking of a crisis, I'm not going to say that this is it right now, but if we're going to see it, Jamie, when it does happen, where we're going to see it is in terms of the bond market. We're going to see a spike in yields. Again, this is not huge so far, but it is notable, I would say, the 30-year Treasury yield back above 5% here, highest level since 2007. We're looking at 5.12%. And when it becomes an actual crisis, and once again, I don't think we're here now there. This is what you're going to see. There'll be a real revolt in terms of people do not want to buy this debt because they do not believe that the government's going to do anything but try to inflate their way out of it. So it's not that you're not going to get your money back. You will get your money back. It's just going to be getting that money back in a dollar that's worth less. And that's exactly what we've seen so far this year with the US dollar having one of its biggest year to date declines on record.
Yeah. Well, it's funny. First off, it just reinforces kind of a core tenet of creative planning that with the challenges in bond markets, challenges we've seen for quite some time now, you're rewarded more for being an owner versus a lender over the long run, just as empirical fact. And the recent volatility, the spike is a concern. Actually, my father, I was having this conversation at the kitchen table with my father-in-law this morning. Like this is the
Wow.
stuff we talk about at the Battmer kitchen table. But also he's in town because my wife and I, my wonderful wife who's put up with me for 20 plus years, we're actually heading overseas to celebrate our 20th wedding anniversary tomorrow. And so I am personally being punished for the decline in the US dollar. But the answer is again, it is just
Not giving you any sympathy. No one's going to give you
yeah,
sympathy.
exactly. I couldn't be more thrilled, and maybe I'm in a better mood because of that. Super excited. First time we've done something like this since we started having kids 14 years ago, right? So it's a brave new world or a world we've forgotten, but it is what it is. And again, bonds, they serve a purpose, but they serve a purpose to allow you to just not have to care about what's going on in politics, not have to care about what's going on in the markets. It's what your short, midterm cash flow needs are. And so it can get worse, it can get better. And bonds are typically just going to slug along, some good, some bad. So that's why you keep it really conservative. But you can tilt that money into the equity side that's longer term, tilt into the private market sides, right? In elements of private credit, it's not better than public markets. Some people are trying to sell it now as this panacea of our problems. Absolutely not. It's just different, right? And it responds to higher inflation, higher yields, more effectively than traditional public market
Is
fixed
that
income.
because you have more floating rate
Yeah, it's
securities there?
effectively direct lending to businesses with zero duration. It's effectively floating rate, and by just how it's structured, businesses like it because it occurs more quickly. And so yes, it's not beholden to a locked in interest rate of the moment.
Yeah, so this impacts, so people are wondering, well, how does this impact, the economy outside of investors in the bond market? And the bond market investors, your expectation should be the yield. So 10-year treasury yields for
Yeah.
4% and change, that's what you should expect in terms of the next 7 years in terms of the bond market. And you can deduct inflation from it. And as Jamie said, the equity market is historically most 10-year periods, most 20-year periods, the equity market far surpasses the bond market in terms of real inflation adjusted returns. But how is this impacting other areas? We're going to talk about housing later. Well, the 30-year mortgage rate tracks the 30-year treasury, not exactly because there's a spread in there as well, but now we're back above 7% in terms of this mortgage rate. So that's obviously pulling back demand in terms of the housing market, in terms of construction. Looking at new housing starts, levels have gone down so far this year because of this, and we've seen just a collapse in demand in terms of new home buyers. We'll talk about that later. But in terms of the Fed, Jamie, very different reaction here than a month ago. When we were looking at the lows in April, the market was essentially saying the Fed put is coming. Like we're going to get 4 or maybe even 5 rate cuts. The first one's going to be in June, and with the huge market rally, almost 20% on a closing basis off the lows, we've seen a complete shift here. So a number of factors going on, but now the market's expecting really no chance of a Fed rate cut in June and only 2 cuts in 2025, the first in September, the next in December. So what's going on here, I think, is a lot of things. Number one, it's the bond market, and investors are saying, well, if we're going to have bigger deficits, we're likely to have higher inflation, all else equal. Well, the Fed's not going to be able to be as dovish. And then you have the other element where we still have the uncertainty, obviously, over tariffs. Is that going to push up prices? Is that going to cause economic weakness? And what Powell has been saying, the Fed's been saying, we're just going to wait and see for another month or two because there's just more uncertainty than we've had in a long time.
Well, it showed like in the very, very short run, like what's going to happen at the next Fed meeting, they're pretty good at it, right? So you can say it's good.
Yeah.
What's going to happen is what they say. But the longer term stuff, just utterly useless. Their crystal ball is no better than ours. And it's interesting. I got excited talking about my wife and I's anniversary. That was what my father-in-law actually asked me about this morning. Hey, with the deficit and are rates going higher or lower? I said the only honest answer is we have no idea, right?
Which rates? Did you ask him which rates? Or
Yeah,
was he
well,
specific?
yeah, I was rushing to get out of there, get stuff done further. But the idea is, okay, last year, right? Wall Street's top strategist, 9 interest rate cuts, right? That was a consensus view. We
Yeah.
didn't get anywhere near that. Again,
We
this
got
is the
4.
same crowd that
Yeah.
2008, the beginning of it, Barron's pulled the top 10 Wall Street strategists. The average expected return for the S&P was 11%. Well, what happened in 2008? The markets were down 39%. So they only missed it by 50%, right? And so yes, it seems like can interest rates go down, but no one knows in the longer term. They don't know any better than us. I don't want
Definitely
to
not.
detonate the Federal Reserve like you, Charlie. But
They should not have this responsibility, Jamie. I'm not going to back down from that.
but the idea they're just reinforcing forecasting the future is fool's gold. Even if you're controlling interest
Yeah,
rates.
it's a tricky game because interest rates did go down last year on the short end.
Yep.
And the crazy thing that we've seen, which we haven't seen in the last 20 years of rate cutting cycles, is the long end's gone up. So the Fed cut rates 100 basis points, and the 10-year now is 100 basis points higher than when they started cutting rates. Mortgage rates are higher. So that's a very different dynamic. And that to me tells you that the bond market, at least, is saying this period of higher inflation, it doesn't have to be 9%. We don't have to go back to that, hopefully not, that we saw in 2022. But we're not going to go back to the very low, modest inflation that we saw in the 2000s. That's at least what, to me, the message is right now. And you have all of these concerns built in that we're going to have this increase in terms of the debt and the deficit. And that's going to put upward pressure on the long end of the curve. But I want to move to the equity markets. The world strikes back. And Jamie, pretty interesting that if you didn't look at the stock market at all so far this year, and you just woke up this morning and said, let me check, how's the S&P doing? And you saw, oh, it's flat on the year. Oh, it's probably been a boring year so far, right?
Yeah. Yeah, exactly. Yeah, go to sleep, or since the last time we were on this, and say, oh, but again, extraordinary volatility. The only people are like, well, these are uncertain times. The only certainty is that all times are uncertain. And yes, we had this tremendous volatility, but those that took advantage of it, right? Tax loss harvesting throughout it, rebalancing, my 14-year-old, did aftercare at her school. I funded, a Roth IRA for her. You recommend people if you're in a position to front load your 401k contributions. You know, you know, Terrible investors just emotionally react that, jump off that roller coaster right at the bottom in April. Absolutely, it's fine just to stay the course, keep calm and carry on. But if you're really optimizing things, if you have professionals like us helping you with it, you're taking advantage of these things. And there are things that are driving benefits regardless of what the markets do moving forward. You're just dealing appropriately with what has. So like through this, if you went to sleep, oh, it's fine. But there's a lot of opportunity in between, and nothing of it had to do with market timing. It's just taking advantage of the current market conditions to optimize everything within your control.
Yeah, and I think this is good, well said, but this is a good kind of lesson for people in terms of checking your account and the frequency of checking your account, where most people tend to make bad behavioral decisions when the market goes down very quickly. And this is probably just yet another example of why there was that famous study that looked at people, how many times they checked their accounts, and the ones that didn't check it at all essentially did much better, right? Because of the lack of panicking and selling out during volatility. But now we've seen the volatility in the other direction, Jamie, which people are, of course, very happy about, right? We don't like downside volatility. We love upside volatility. And this is really a who's who of when you look at this list here of biggest rallies over 27 trading days, these are historic market lows that now this year is on the list with one of the greatest comebacks you'd have to say in history. You got March 2009 on this list, August 82, October 74. For market historians or nerds like me, like these are all dates that you remember, March 2020, right? These are the biggest rallies in history. Like a low was hit, and then the market didn't just go up gradually, it rocketed higher. And now we're in this list again. And the big question I've been getting, Jamie, is, well, you showed all of this data in April when the market was crashing and the VIX was spiking, that was a huge bullish signal looking out 1, 2, 3 years, right? When people are panicking, there's a lot of fear, you tend to see better returns going forward. How are you now showing that there's tends to be strong returns following this period, which is the opposite, which is essentially a huge move to the upside? You could say panic buying. And how would you explain that to people?
Well, okay, just stepping back, all these time periods, 2020, COVID, right? 2009, global financial crisis, early 80s, right? Interest rates are spiking, we were dipping in a recession. It's always darkest just before the morning light. And it's hard. The idea, don't look at your statements, yes, but actually, it's like human nature, right? It's like, oh, if a bear is mauling you, play dead, right? Not happening. Human instinct would tell you not to. But if you want to do something, do things where you know you can add value, like that tax loss harvesting, like rebalancing, because you, us, anyone has no idea what the future holds. Again, this is what the historical data says. Again, when Charlie and I in our investment policy committee, we're doing tax loss harvesting, doing rebalancing. The idea is, oh, in the short run, we have no idea, but in the long run, it's math, and it just reinforces don't trading off making sweeping changes based on this data is always wrong, because you never know, this might just be the complete outlier to these historical times. And so just not getting emotional to the fear-based side during any of these dates. It's just as important to not get emotional to the greed side when things really take off like this. It has to be right for you. It has to be customized, and just don't jump off the roller coaster, right at the depths of the precipice.
Absolutely not. Yeah, in terms of outliers, this is already an outlier because all of the other dates that you were talking about and mentioned there was a recession in the US. The bear markets were deeper than what we saw this year. So this is already unusual in that we haven't yet seen an economic downturn. Some people arguing it's coming, but unlike these other periods, unlike March 2009, Jamie, where you had the worst recession since the Great Depression, this is a very different period right now. You still have very low unemployment. You still have the economy doing pretty well outside of this tariff uncertainty. Very different situation. So when you look at those 1 year numbers from these other periods, keep in mind that the market was much lower on a valuation basis in all of these periods after this rally than it is today. So definitely don't expect the next 27 trading days to have a huge advance like this. And I definitely don't be expecting 40% over the next year. Could it happen? Of course it could. Anything is possible, but that shouldn't be your base case scenario looking at this chart. But it should also tell you, Jamie, that it's not necessarily a bearish thing when the market goes up a lot. It does tend to continue to go up. Strength does tend to beget strength.
Absolutely. And like you said, for investment geeks like us, you called yourself an investment geek, Charlie. If you're a geek, then what's that make me? Like one of those super geeks from Saved by the Bell
Yeah.
or something like that?
Yeah, your
It's
Screech or the Revenge of the Nerds,
yeah, I
go
guess
back to
so.
those movies.
Proud, but it's data driven. This time is never different, right? What pushes it, right? We've had 30 pullbacks in the last 15 years. I couldn't name half of them. In the moment, they all felt like it calamity. Let the long-term data, let your personal circumstances drive the decision making, not what the headlines are screaming at us 24 hours a day.
Awesome. So let's talk about the other big story in the markets, Jamie. And we touched a lot on this a little bit in March, but now we're further into the year and the gap is eye-opening. And it's eye-opening because it's been a long, long time since the US has been among the bottom performers in terms of country performance. S&P's down just a little bit on the year, as we said, pretty much flat year to date as it stands today. But if you go to Europe, 20%, Eurozone, 24 plus percent returns. If you take everything outside of the US, up close to 14%. Even emerging markets, which have been beaten down, up almost 10%. This huge gap between the US and the rest of the world has been the opposite direction for over a decade. And now we've been talking about this mean reversion. You and I must have had a few weekend charts where we said last year, this is an extreme we've never seen before. Don't expect it to continue. When is it going to revert? We don't know. But this is pretty huge here. The first 4 months of the year, 16% outperformance international over the US. This is pretty meaningful. You're starting to hear in your conversations with advisors and clients people talking about this, or is this still too early for people to be making anything of it because you just had such a huge period of outperformance in the other direction?
Yes, people chasing international now, flooding money there, just as wrong as flooding the emerging markets 15 years ago after outperform or flooding to Mag 7, as it was dominating. They serve a purpose in all market environments. It was great during this recent volatility that these things were, Europe was hitting all-time highs when our markets were down 20%. A lot of
Crazy to see. Yeah.
Mag 7 were down even larger. But think about that. Europe, they hit all-time highs during this. That was the first all-time high they'd hit since the year 2000. Whereas, all-time highs for domestic markets, we'd hit like 385 of them over that same time period. And so, like, the chart before, like what you should have, global economic, data should drive how much you have in each of those portfolios, right? It's not Charlie and I, our investment policy committee, even though Charlie was like, we got to put everything in Poland. Like he nailed it, right? He's like
I did
100% in
say, I'm
Poland.
glad you mentioned that. Yeah.
And so no, but like Poland, it's
I can't
great.
tell you one stock in that ETF, by the way.
What's fascinating, again, talking about the super geek, interestingly, Poland was the only European economy to not dip into recession during 2008. Poland has been
Hmm.
at the crossroads of major empires, using it as a battlefield for like 1,000 years. Again, the stuff that the Germans and Russians did in World War II, they're terrible, right? And so it's hats off to them. They're kind of
Yeah.
unencumbered by this now and being able to grow, but we never know. It could have been the exact opposite. It can be moving forward. Trying to tilt into this, it's just performance chasing. And unfortunately, people make the exact wrong decisions at the exact wrong time. The weightings too, these different dynamics should essentially be based upon what global market cap weighted dynamics say you should have in these. That should be the guiding light, and then of course modified appropriately for you. Let's say you work for a company based out of Denmark, right? You work for Novo Nordisk, maker of Ozempic. That should be adjusted accordingly, not trying to time the winners, time the losers, even though hats off to Poland for doing a pretty dang good job over these last 25 years when they've had to go at it their own for first time in a long, long time.
For sure. And just last point on the equity market's kind of incredible to me, Jamie, how our attention span in terms of the thing we're focusing on shifts so rapidly from one thing to the next. And really all you could talk about for a few weeks was tariffs, tariffs, tariffs. And then we had the UK framework for a deal. Still don't think that's been finalized. The China pause reduction, huge announcements that kind of lifted the spirits of markets. And the expectation in terms of the market, this is my interpretation, is the market doesn't believe that even the current effective rates, which is about 15%, if we look at all countries and we break it down by the US trade with them, the market doesn't believe that that's going to stand, or it doesn't believe that's going to have a negative impact in terms of earnings or the economy. Very different than obviously the expectations that we had in early April, where pretty much everyone was saying recession for sure, higher inflation's coming, and this is going to be bad for stocks. Is it incredible to you to see this shift in such a short period of time in terms of the narrative here? And is the market today being too, I'd say, optimistic or ignoring the risks that are still out there surrounding this?
Yeah, I mean, there's a whole host of risk out there, right? But the market is doing what it should do based upon rational historical data, right? Again, there's multiple iterations of backing off as things got choppy. Just like we were talking about with the debt ceiling, right? Making some wild oscillation. History tells you it's going to be raised, right? Better or worse, longer term. And that's what
Yep.
it's doing here, right? We've already seen, a thawing on both sides. So, say United States and China at the core of that, but let's step back and look at the facts, right? Was it 98% of ibuprofen originates in China? 63% of the goods on Walmart shelves originate in China. Unless, you and I are willing to pay, a lot more for ibuprofen, a lot more for the majority of stuff we buy at Walmart, something's probably going to work out. So it's appropriate for the market to do this. And again, the hope is it actually creates a freer world without these arbitrary taxes at the country level disrupting things. Again, who knows if that's going to happen? Who knows if it can't? But we think there's a decent chance it might. But the market is responding to it appropriately. And like everything, down the road, if worst case scenario, people are going to say, "Oh, it was so obvious. It was so obvious this was happening." Not true. Check the tape, see if someone actually said that beforehand and they didn't just happen to get lucky, right? Again, and so the idea is we don't know what's going to happen. The markets are responding appropriately based off historical conditions, but hopefully it puts the world into a better spot. But hope is not a strategy, and just we need to respond accordingly as conditions actually manifest themselves.
Right. We just don't know. And it's okay to say you don't know. And my take all along has been there's nothing permanent about any of this. Like from the Liberation Day announcement to the big pivot they made on April 8th, essentially saying, forget all that. We're going to pause it for 90 days, but we're going to hike China. There's no permanence to any of this, Jamie. That's essentially what we've learned. Even if, let's play out the worst case scenario, they leave the rates where they are in this chart, that causes a downturn in the economy, causes higher inflation. How likely are they like to keep them? If they're stubborn and they keep them, they're going to be voted out of office. The next people that come in are going to immediately reverse it. So there's no in my view, there's no scenario where long term this is going to persist if it has a negative impact, right? Coming back to politicians want to get reelected, they're incentivized to get reelected. They can't have a recession on their watch usually and get reelected. So this isn't going to persist if you're seeing it. And it only took like a week of the market going down a lot for them to reverse
Yeah.
course.
Just never say never and never say always, right? And could it get worse? Yeah. Do we expect it to get worse? Probably not in the short run. Who knows? Long run, probably not. Hopefully it trends the other way. But, you know, all those countries we listed, right? Beginning of World War One, they all told their people that the war would be over, before winter. Well, that was a great way to trick people into a 5-year meat grinder that completely transitioned the world. So you never know, when those outlier events occur. and do not waste any time trying to pre-guess them. Even that, again, The Big Short, right? Entertaining movie. The guy I can't remember, the guy who hit it right? Yeah, Michael Barry. If you follow his strategy after that, the returns have been dramatically less. There was a guy that called the 27% decline in 1987. All the money came flooding his way, just like insanely missed out from there on out. Like the worst thing you could do is essentially just because someone happened to guess right once, it's actually even lower odds they're going to guess right moving forward. Tune out that noise. Save the soothsayers for the sideshows.
Absolutely. Speaking of tuning out noise, at creative planning, we use a data-driven approach to managing your money. If you're looking for a second look on your portfolio, your financial plan, reach out to us today at creativeplanning.com/Charlie. We're in all 50 states, so we likely have a location right near you, over 350 billion in assets under management and advisement. We're here to help, so reach out to us today, creativeplanning.com/Charlie. Jamie, I want to touch on the housing market very quickly here before we go to the last segment. And what we're seeing is long awaited, but it finally seems to be happening. The lock-in effect where people were not listing their homes because they were locked into these low mortgages and they couldn't afford to buy a new home if they moved. That seems to be easing here. We're seeing the highest supply since March 2020 in terms of the U.S. housing market overall. Of course, every region is different. I'm going to have people messaging me saying, not in my market, there's no supply. But overall, in most locations, supply is going up. We've got 1.9 million homes for sale listed right now. That's over 15% increase from just a year ago. And in April, we saw the first monthly decline, not a big decline, but it's notable because we rarely have seen the housing prices overall go down in the U.S. First monthly decline since 2022. And if you look at the affordability picture, Jamie, my prediction is that the gains of the past 5 years are simply not sustainable. And this is actually a good thing because the housing market has to get more in terms of a balance. We have the income you need to afford the median priced homes to sell is 57% higher than people's actual income, which is a record high. It makes absolutely no sense, of course. And so one of two things needs to happen, or three things, I should say. Either prices have to come down, mortgage rates have to come down, or people's incomes need to go up. And people's incomes are going up, but not nearly enough to close this gap. So housing prices next 10 years, lower your expectations. Would not be surprised on a real basis, so adjusted for inflation, to see a decline over the next 10 years. Any thoughts on the housing market, Jamie?
Yeah, I mean, over the long term, it's essentially just kept up with inflation. But really, from a technical terminology for what this graph is showing, the technical term is this sucks. And reason why it does for people is that having a home is, one of the few real assets that your average American has. Essentially, they have value in their house, and they have value through their 401k. Is what the data says. And what's the common element to both of those things? They're both kind of forced savings plans, right? You're making a
Yeah.
mortgage payment every month. You're paying more principal ownership. You're contributing your 401k every couple of weeks. Again, it's a great way to take advantage of this, but most people are auto enrolled into that. So all the data says those are the two real assets that your average American has. And the fact that this affordability gap is just blown out, you're essentially stunting a lot of people being able to march down that path. Are there, when you factor in all the costs for the house, right? All the backbreaking work on the weekends and all that, houses rarely make as much money as people think. Even when you look at that, look at the total dollar amount of cost. But the
Yeah.
fact it's a great way to build value over time consistently, and it's like 57% more difficult for a lot of people to embark on that journey. So houses go up, go down, who knows? Florida, dating back, there's like a picture of Teddy Roosevelt like riding like a baby elephant at the turn of the century. It was like a Florida housing advertising thing.
Yes.
This
I
huge
know that
bubble, it
picture.
burst.
Yeah.
Florida, huge bubble burst. But you know what? Over the long run, the long term, people should be focused on. Human beings are probably going to want to flee, like where I live when it's negative 20 degrees in the wintertime, go to places like Florida. So think of it as a place to hang your hat, kind of forced savings plan. love your family in, bring kids home from the hospital, bring the grandkids down to visit you somewhere nice. And it just stinks that it just becomes so cost prohibitive, so dramatically over a really short period of time.
Yeah. And then we're not going to go into the underlying causes we have before. It's in part due to the Fed, in part due to the federal government, in part due to zoning regulations in terms of supply. But the point is, it can't persist. It shouldn't persist. It's not good for a nation to have this affordability gap. It delays household formation, which is a huge negative. And you just don't want people reaching, Jamie, in terms of like this is going to be one of the biggest purchases, probably the biggest that people are making. And a lot of people are deciding now, should I reach to do that? That's never a good idea. So, to the extent that you can wait until you can afford that home, that's very much advisable today. I would say more so than most periods of time because of this gap. But of course, it's tempting. And you just don't want to have a nationwide policy that encourages home prices to deviate from people's incomes this much. It's just not natural. It's not good for an economy. It's not an exportable good. So we shouldn't view it in the same way we view the tech industry or any industry in the US that we can export to the world. It's a depreciating asset at the end of the day, right? Where you have to put a lot of money into it. And there's value to that. There's emotional value. And it has shown to keep pace with inflation, and people have built a lot of wealth. So all of that is a good thing. But viewing it purely as a speculative investment, which I think more people are doing today, similar to the housing bubble in the 2000s, should view it very different than invest in the stock market or commercial real estate that you're renting out or things like that. You're living in this, it has a value to it, but don't assume that the 10% per year appreciation that we've seen in the past decade, that's
Yeah.
normal by any stretch of the imagination.
Yeah, well said. Absolutely agreed.
All right, let's go to the last segment, something positive you always end with. We're heading into Memorial Day weekend, Jamie. And of course, want to thank everyone for making the ultimate sacrifice. The fact that we can do this podcast and live in a free country and enjoy everything that's great about America is an awesome, amazing thing. So we appreciate that very much. But I want to talk about the long piece here because this is a great thing for my generation, for our kids' generation, is the fact that, relatively speaking, I know there's a lot of bad news in the news, Jamie, and I'm not saying that there isn't war out there, but we've had since the end of World War II between major powers a decrease in interstate wars. There's a lot of different reasons for that. One positive here is that countries have become more democratic, wealthier, our economies are more intertwined, and that has led to a decrease in it. And just the chance of you or I or our kids being born and dying in a battle have gone down significantly since the end of World War II. And you could just see that huge spike, terrible period there. So this is all very, very good news. And I think that gets lost in the day to day, very short term periods where we're hearing about conflicts going on around the world. And of course, there are many, but taking a bigger picture view, this is nothing compared, thankfully, to what we experienced in World War II or before that.
Yeah, that's great. Personally speaking, my dad, who I love, is still going strong in his mid 80s. He was a Vietnam combat veteran, and for what he experienced, the fewest people that can have to experience that stuff, the better for society. And just from my personal life and the extraordinary, things that he had to deal with to give me and my brothers and my mom and family the life we had. And so the fact that this continues to trend that way is great. And that's the thing. It's really interesting. It's wonderful. The slaughterhouse is tragic. Limit that, but it's still going on. And the idea of really interesting. General George C. Marshall, right? That they very involved with winning World War II. The creator of the Marshall Plan that fed a starving Europe in the post World War II era. Yeah, I think he said something that along the lines of with the Marshall Plan is putting the world in such a strong economic embrace that no one could rear back to punch each other, right? And so the more prosperity, the more interconnectedness, the better. And you have these fits and starts, and people can spin it one way or the other. But clearly, the data is showing, it's trending positively. And yes, a very, very good thing to end on. Even though impressive, Charlie. Talking about war fatalities is a good ending, but it's great to see this trend line.
Yeah, awesome. And the the point on that is war is bad for everyone. War is hell. It's not good for anyone. And the opposite, peace, leads to prosperity across the world. So the more peace we can have, the better. But of course, we should be mindful of it. People are going to have a lot of barbecues, a lot of fun this weekend. We should be mindful of those that paid that sacrifice for what we enjoy every single day. Jamie, I want to wish you a great trip. Happy anniversary again. Thank you so much for joining us on the Weekend Charts here.
Yeah, thanks for having me. And have a great Memorial Day weekend, everyone.
Awesome. Everyone, if you're watching this on YouTube, hit that subscribe button for all the latest content from us, and we'll see you next time on the Weekend Charts.